Good afternoon and welcome to the CPP Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. You can be submitted at any time using the Q&A tab situated in the right-hand corner of your screen. To click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, review all questions submitted today and must publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Simon Piper, CEO. Good afternoon, sir.
Hi, good afternoon. Thanks for the handover. Welcome everybody. So, quick deck through our interim results. I have with me Sid, who is our Chief Executive of Blink, and he'll have a little section take you through Blink, which is our insurtech parametric business. And I also have David with me, who's the CFO. So get through the so what we're going to cover: financial highlights in the first half. A reminder about what we do and where we operate and what we're doing moving forward. Then I'll hand over to Blink on the Blink. So Sid, talk about Blink Parametric and a little bit on the financial performance, and then hopefully at the end we'll have time to answer some questions. So, pretty much the first half results are pretty much as we expected. We had good revenue growth from our core businesses, and what we mean by core is, our Indian operations include Globiva, Turkey, Blink Parametric, and our central functions. The growth of 25%, and legacy, continues its revenue decline, and it just kind of supports further the reason why we need to close that business and migrate away from it over time. So generally, good reported revenue numbers. No surprise to the city. I mean, in terms of what we were expecting, and as we started the year, we expected to see some margin change. A number of reasons for that. Fundamentally, as the legacy business declines at a group level, that's a higher margin product. So and then obviously the lower margin products, India takes a little bit more prominence. And then with India, there's been growth in one of the products which is slightly lower margin. That's actually driven a lot of the revenue growth. We also knew that Blink was very much going to be an investment proposition for us this year and into next year. So that's pretty much performed very much in line with expectations. The surprise, if there was any, was the softening in the currency exchange rates. Our largest source of revenues in India, so the Indian rupee, that's seen a weakening since compared to last year, and also the Turkish lira has continued to depreciate, and that will have an impact in the second half. But obviously we've maintained our earnings forecast this year, and what that's saying is that we're managing that kind of impact to our profitability. As we are just a little bit better, should we say, we are a little bit better than expected in terms of the management of our cost line. Cash decreased due to some working capital movements, but again it was a planned investment in Blink, and there's some issues, a little bit of issues in the Indian times and working capital, but nothing really of surprise. For those of you who are unfamiliar with the business, historically the group only ever showed its reported balance sheet cash at 16, and that always masked a bit of an issue, which is that we have a bit of restricted capital or cash. And what that means is we have about £2 million of cash in the UK, which sits in our insurance business, and we have to keep it there as as a regulatory requirement. We have to keep minimum capital there in the event there are a number of claims that need to be paid. Over time, as we unwind that business, that cash will come back into the group, but not in any time in the short-term forecasts. The largest chunk of the restricted cash relates to cash which sits in India, so we can freely distribute cash in India within India, but it's a little bit more difficult to repatriate all of that funds directly back to the UK. We have to keep certain amounts of cash there and as a reserve. So there's just a little bit of technical reasons why we have to keep cash there. So it's not free to move or repatriate back to the UK, leaving us with around 10, which is readily available at any one time for working capital management. I think one thing, this is an interesting slide for some. It's really trying to explain where we as CPP see ourselves. In the insurance value chain, you have one side of it, it's when the underwriters, and they have the risk and the pricing. These are the large companies like AXA, Zurich, Chubb, and so on and so forth. And they have, they're large multinational companies, and they have very strong balance sheets. And then on the right-hand side, you have the distributors of companies that will sell over-the-counter travel insurance policies or credit card companies, banks that have direct relationships with customers. We have neither. We don't have a balance sheet that we can leverage to any degree and write policies and look to try and take margin. The previous management did try and invest in an MGA to try and leverage the balance sheet a little bit. It just didn't work. Couldn't do it. You have to do that at scale, and we never were going to have the scale for that. And we don't have direct access to consumers, and so we have to find a role for ourselves in the value chain. And through happenstance and through a bit of design, where we've ended up is we are now building suites of products and services which wrap around underwriters' products. So underwriters give us as our route to the consumer, to the end consumer market, and they will work multiple geographies and have multiple routes to consumers. And actually, when Sid talks about Blink, that's the route we're taking with to distribute the Blink product. Partner up with a larger multinational. Once they adopt the product, they will then distribute that on part of the new business or renewal book in multiple geographies. Now, it's not a quick process, but it's a cost-efficient process, and it gives us geographic footprint that we just wouldn't be able to do on our own. So what do we do? Well, it's quite a nice little sidebar, the narrative. Our products and services are only ever used by end consumers when they're having a bad day. No one ever uses a CPP product or an insurance product when they're having a good day. Something's gone wrong in their day. And we try to develop products and services which make a bad day better. And it's not going to make the day as good as it would have been if the incident didn't happen, but it's certainly that's kind of the mantra, the way we think about products. You're trying to make a bad day better for the consumer. Products that add real value to the consumer, but also a point of differentiation for those underwriting firms. We have 6 or 7 categories. The largest one at the moment is My Health. That is largely an Indian-based products sourced through Bajaj, and that's pretty much you buy a Bajaj product or a loan, you take out this healthcare product, and that will give you access to online GP appointments and reduce costs for drugs and so on and so forth. My Finances is very much the old car protection. We're not writing and haven't written any new car protection policies in Europe since 2012. But there is still quite an active car protection business in India and in Turkey. And in Turkey, for example, they have a number of good relationships across a broad spectrum of the banks. It gives the banks something more to offer to their credit card and debit card holders. And then we have things like My Tech, again, largely an Indian product, which is around gadget, mobile phone protection, gadget performance, and then My Home, and so on and so forth. And then you have My Travel, really, which is the flight, which is our smallest revenue stream at the moment. But is our largest source, shall we say, our point of focus in terms of trying to grow this business, and that's the flight disruption and lost luggage business.
Motion detected at the front door.
Excuse me. In terms of revenue, you can see these are half-year results. You can see the size of some of these businesses we have, or revenue streams or product streams that we have. My Health, 30.2 million of revenue. Significant growth in prior year. Why has it grown so much? Well, it's a low margin product for us, but a high margin product for Bajaj. So they have got behind this in a big way. In terms of My Finances, again, good growth. That growth is driven through India and through Turkey, but good growth out there. And so for those top three, are the My Health, My Finance, and My Tech currently generate majority of the group's revenues. You then have a second tier at the moment, My Home, and then you have the sub 3 million revenue streams. And then in Globiva, which we have which is a BPO call center business in India, that generated about 7.5 million revenues. Now, the thing with Globiva, it's a non-core business for us. There's not a right time to realize some value from that just yet. Most of the clients it serves are local Indian clients. If you have non-domestic clients, and then you get a premium on the sale. And most of their clients face the tech. It's kind of like they would service companies equivalent over here, like Just Eat and so on and so forth. And they've seen a bit of a tech crunch out there. So probably not the best time to look to realize value. And also it just require a huge amount of management time to exit that business. And there's other things for us to focus on in the near term. So this again shows you the importance of India. So when you look at the products and our product suite, and you can see Livecare is huge for us, and you can see where it's generated from. Most of our revenues come from India. So the capital light business, but it's a volume business. It's low margin but high volume. It's very profitable part of the group. It's got good prospects. We've just delivered a new platform, IT platform, which helps service its customers at a lower cost. And we've got another part of the platform, which is on the card business, which we'll be delivering by the end of the year, starting next year. Turkey, now on a reported basis, looks level on last year, but I think on a constant currency basis, it's also, correct me if I'm wrong, David, about 70% up. So what's happened is the micro and macro issues in Turkey and the decline in the Turkish lira has offset the volume benefit that we've seen in Turkey. But a really good business, good diversified product suite, and a very established business with the kind of the banks and insurance and the underwriters in Turkey. And the legacy 6.5 million of revenue in the first half, but that's a declining business for us. And if you do nothing on the legacy business, that would lose 5 or 6 million pounds in around 2026, because the revenues are declining, but it has a very high fixed cost base, which we're attacking and addressing as part of this change management program. In some respects, I should have started with this slide, because what are we trying to do here? Where are we trying to get to? And we're not. These are the results are fine. Our progress through the change management program is fine. We've got proof points in terms that Blink is working, and that's great. But what's the story here? What are we trying to build? And fundamentally, when I joined at the start of 23 and 2022, we had a business that was in terminal decline, which is the legacy business. And there were no plans in place to address it. We had a start-up in effect business in Blink that had been acquired in 2017, been left to one side and to be run by the founders who came over as part of the acquisition. And then in 2021, Sid was moved over as CEO, initially to try and look to sell it, which there was clearly no market for it during COVID. And there was the Indian business, which was growing very strongly, but with two large partners, Bajaj being the largest. But there was no cohesion to them, and when we get to the end of it, there will be some inconsistent parts of the business here. So the journey we're undertaking is really to exit the legacy business. That will allow us, as we migrate onto new IT platforms and into this year, into next year, to reduce essential overheads by a couple of £2.5 million on an annualized basis. We then spend £1 million on the new IT platform in India, and that should improve the EBITDA margin in India. But it also allows us then to start closing the legacy close the legacy businesses as we migrate all those policies onto new platforms, be it Turkey or another third party. India or another third party. But that transition again will take a couple of years, so we won't exit fully from the legacy business until the end of 25, and we'll still have some service commitments beyond that, but it'll be tiny. And what you get to in 2026 is you'll have a Blink business, which we hope will have revenues somewhere north of £6 million at that time. It'll be a business that has high operational gearing, high margins, and the key thing, a little bit similar to my background in business information and subscription-based products, it'll have high recurring revenue. So Blink, for example, this year has achieved 100% renewal rates on its existing customer base. But more importantly, has increased the length of those contracts on average from 3 to 5 years, and increased the volume parameters. We've had a number of new business wins this year, and we had a couple more which were signed off today, which we'll announce, another couple of wins, which we'll probably announce later this week or next week, and the pipeline is getting more and more robust. But you get to the end of that, and you've got a business, we've got high visibility of earnings, high margin, highly operational geared, and that will generate a lot of value in that one business unit. You'll have India, which is a little bit like CPP of old, but in a very important, fast-growing market with a new IT platform, which we hopefully develop new products for. And you'll have at the centre a lower cost model, which is really just around allocation of capital, investor relations, so on and so forth. So you'll have three kind of business units. You'll have Blink, which is a group-wide product, with a product that we can take in multiple geographies at relatively low incremental cost. You'll have India, and even if it stays the same as it is now, it will be a very large part of the business. And then you'll have our Turkish business, and then, as I said, a much smaller central overhead. And that's what we're trying to do. Everything we do and work towards is to try to build out that Blink business, maintain and grow our Indian and Turkish businesses, and execute this change management program. But we are towards the end of 23. We have all of 24 and 25 to deliver this change management program. So there's a lot of work to be done between now and the end of 25. And one of the things we aim to achieve as we do these investor roadshows and presentations like today is to keep coming back with more proof points, more customer wins to Blink, further progress on the change management program, and meeting our earnings forecast, each half in each year. And so it's just about being consistent as we get through to the end of 25 and into 2026. So probably a little bit loquacious, that narrative, but this is quite important. This is our kind of guiding sort of picture we work to in CPP. The change management program, often referred to as the CMP, is the how we get there. How do we get from one part of the business, legacy business in decline, to where we want to get to in 2026? So we had a full year 2022 of the planning. I joined in January. I undertook a big review of the business and the strategy and what we could afford, and set the strategy with the management team. But we spent a good part of 2022 planning for 2023 and the change management program. We came with so the way the business runs itself, we have a management committee, which is called EMC, which meets every week, and that's kind of the main decision-making body. Once decisions are made, you then go into the operational board, which is all about execution and delivery of the change management programs. And then alongside that, then you'll have a number of project management officers. And I sit in all of these meetings, whereby we look at the development and delivery plan for each of these programs. So 2023. The key objectives for this year was to deliver phase 1 and 2 of the Indian platform. Phase 1 was to migrate to build a new platform for the Bajaj, our biggest business in India, part of business in India. We currently, that was launched at the early September, so just after these results talk about, and we currently have 500,000 live policies on that. That's a good platform. By the end of this year, end of January next year, we'll have the second final part of the India platform build completed, and that will allow us then to put the card business onto the Indian platform. Then at that stage, India's platform will be completely independent of the group. It's all Amazon Web Services based, and it gives them a good point to be more flexible in terms of how they deal with their customers and their clients, and also for future product development. We started the legacy runoff now on legacy business. So we communicated to staff in Spain. There's about 70 of them that are going through redundancy process. We've talked to a number of the UK staff, particularly around IT, in consultation now around their exiting. So there's around 25 staff that are active under redundancy consultation. And then we continue to build out the capability around Blink. You then move into 2024, another year of implementation. You'll decommission of 2 platforms that we have, which manage all the card and policies at the moment, save for what's in India. They will be closed in first quarter 2024. That's internally they're called as MPP and Protector. That then will allow us to save a significant amount of costs around licensing costs from Oracle. And then we release the headcount. We have around 24 people in IT in the UK just supporting these 2 platforms. And then we'll migrate some of the legacy policies onto a third-party platform, because we still have to service them, but it'll be much greatly reduced costs, and we don't have to maintain the software. We just will have third party that maintains the platforms for us at a much lower cost. 25 again into the implementation. Legacy books continue to run off. We then go into reducing essential overhead. So, for example, we have a headcount in finance that will reduce as we close the legacy businesses. We'll have people in the risk and compliance department start to reduce as we have less exposure to the risk and compliance products. HR will change, legal will change. So we've already got plans in place around what the target operating model looks like. And we complete in 2025 then the change management, and by 2026 then we are what we set out to be, which is an insurtech business with a global proposition with Blink, supported by India and supported by Turkey. It all looks great on a graph like this, and it looks really easy. And I remember once one of my very good managers saying to me, Simon, simple doesn't always equate to easy. This is conceptually very simple to get our heads around. There's a lot of complexity in this. There's a lot of interrelationships with, how the business currently operates with business, so for over 40 years old. But we're currently on track, and we are highly confident that we have as much information as we need and visibility as we need to execute the change management program. But my point being is there will be hiccups. We will make mistakes, but we are agile enough to adapt to them. There's nothing at the moment we see here that we think there's a problem that can't be surmounted with the resources and the capabilities we currently have in the house. So, and we will talk about this as we come back every 6 and 12 months to say how we are progressing in each of these key milestones. It forms a part of the annual report. It forms part of our 6-monthly interim report and all our investor presentations. I think David wanted me to come back to this at the end as a kind of a sign-off, so I'll leave that to the end. And I'll hand over to Sid, who's our Chief Executive Officer for Blink Parametric.
Hi, everybody. So I'll just start by just giving a quick overview of what Blink is, how it operates, and the value we create to our target market, which is the large global insurance market. So Blink is an insurtech platform. We use third-party data sets to identify when claim events have happened, which allows us to automate the claims decision-making process for insurers and deliver claims payments or resolutions in real time to customers when things go wrong. Our lead product, which I'll come on to in a minute, focuses on flight disruption. But basically with that solution, we track individuals' flight details. And if those flights are delayed or cancelled by 2-3 hours, whatever's been agreed with an insurer, we would then notify the consumer that their flight's been delayed. We would then send them either an airport lounge voucher direct to their phone so they can go and use that whilst they're in the airport, or we would send some cash straight to their phone. Again, so they're not spending their own money, they're using cash paid from their insurance policy whilst having the disruption in the airport. It's obviously a significant issue for consumers. Flight disruption, the regrowth of travel since COVID has led to increased disruption across airports around the world. And we operate services across flight delay, cancellation, and luggage as well. The way Blink operates is we operate off our own proprietary technology solution. So we have a technology platform which allows us to, yes, focus on travel, but in the future look at a range of different product areas within the insurance sector. We're not limited to single product sets. Anywhere we can identify third-party data sets which allow us to determine whether a claim should be paid or not proactively without the customer having to tell us that they need to make a claim, then we can utilize that to speed up, improve, and enhance claims processes for consumers and insurers alike. We operate on a white label basis, so you'll never see Blink Parametric in any consumer literature or on any websites. Everything we do is behind an insurer, and we either operate with our own a white label service where we manage the whole user experience for that brand, or we operate directly via APIs into their own ecosystem. As a business, we operate in 10 markets, including the US, UK, Korea, and our largest market at the moment, which is Canada. And we're growing quickly as an organization with our client list. And I'll talk about the types of clients we're looking to bring on and we brought on already this year in a minute. But our route to market for the business is to create excellent technology solutions which can be embedded into the core insurance policies of large regional or global insurers. So our current focus, and it will be for the foreseeable, is in the travel market. We've got a very strong pipeline and existing partners within travel insurance. And our solution embeds within their core policies so that they would provide real-time support for their customers when things go wrong, if flights are delayed, flights are cancelled, or luggage is delayed. And we power that whole claims process for them in the background, which allows an insurer to be able to create differentiation in the market by offering a truly different solution to what's out there currently. It allows them to deliver really fantastic customer experience so that customers are getting helped, genuinely helped by their insurer or the retail brand that's selling the insurance to them at their time of need, not having to dig around looking for paperwork and make manual claims back to the insurance company, which can take weeks to handle. They get cash or support when the issue occurs. Both of those things allows them to increase sales performance. So we've got strong evidence points from our existing partners that they see increases in sales of their core product when they include our real-time parametric services. And we also have good evidence points that increases the stickiness and renewal of the policies, which allows them to maintain their existing customer base, their customers renew and stay with them for longer periods. And I think that's also evidenced by, as Simon said, we've got a very strong 100% renewal rate of our existing client list, and we're signing renewal contracts for, as Simon said, 3 to 5 years with our clients, which is a really good support of the kind of value that we bring to insurers in the market. So the solutions that we are focused on currently, the first one is parametric flight disruption. So parametric is really, it's real-time claims handling using third-party data sets. So the data tells Blink and our system has a flight been delayed, has luggage been delayed, or has something else happened that's part of an insurance event. And then our technology engine will automatically trigger a payment or a resolution to the customer based on what they've agreed with an insurer. So as I said, the most simple solution that we have in market is flight delay. And this is our most used solution currently in market. And the benefit for this product is that we're able to, we handle for insurers, the customers will inform us when they're flying, who they're flying with, where they're flying to, and then we're able to track that flight from that point forward. And as I say, if we identify delays or cancellations, we're able to inform the customer and make payments. Now, you can also see there is an enormous amount of data being captured, and that data is something that we as a business believe will be a significantly valuable asset, both to Blink in the future, but also to our insurers and their insurance partners, due to give them better decision-making tools, the ability to upsell, cross-sell, and engage better with our end customers. We also operate a luggage solution. So if your bags don't turn up at an airport you're going to, we're able to send some cash to you so you can buy some ancillary goods and services whilst you're waiting for your luggage. And then if it doesn't turn up after 48, 72 hours, give you a large amount of cash, depending on the insurance coverage, to replace items that you had taken away with you. So it might be a suit for business travel, and other items for kind of family travel when you're on leisure. Now, the important thing with Blink is we don't operate in the regulatory value chain. So we're purely a technology provider. We're enabling insurance companies to deliver in real-time claims resolution, claims support, helping their customers and driving differentiation. We do not carry insurance risk on our business. We've purposely designed this business to operate outside of the kind of core regulatory landscape, so we can deploy these solutions globally, and we're able to deploy them into large global insurers, allowing them to focus on the things that they do well, which is write policies, distribute products, and handle the regulatory side of the business, whilst we enable them through technology. Our other solution that we have in market is focused on cyber risk. So we work with third-party data providers to identify where consumers' data has been compromised or put at risk. That allows us to then trigger communications to those customers to inform them that there's a significant risk to their personal sensitive data, and to allow insurance claims to be paid. As an example, if your passport's been compromised, you might want to replace your passport, so we can trigger insurance claims to them to cover the cost of that passport, but also to provide help, support, and advice from third parties that we work with to operate and help that customer generally improve their cyber risk position. Both of those product areas, cyber and travel, both the same distribution path, large insurers, and then when we distribute for insurers, those insurers will then distribute their products through to banks, telcos, online travel agency, airlines. So our distribution path is into the insurer, work with large insurance partners to embed our solutions, and then work with those insurance partners to broaden that distribution out to a much wider network where you would normally buy home insurance, travel insurance, and online gadget insurance, for example, where these products fit nicely. Our product strategy is, we're, as Simon talked through earlier, we're very focused on the build and ensuring that the solutions that we operate are operated in a very robust way, they're very scalable, and they're market leading for when we operate a product. We're not looking to design hundreds of products to bring to market. We're focused on scaling the products we have, ensuring those products are the best that they can be in market, and that they generally deliver value and scale within the organization. But we obviously have a product development roadmap going into 2024, which you'll see us broaden out the kind of range of solutions that we operate in travel. And we've just recently deployed a new user experience for all of our travel solutions, which will obviously roll onto our cyber products as well. So we're looking to modernize and continue to improve the product sets that we offer to ensure they're scalable and still relevant in market for the future. It's been a busy first half for Blink. So we've launched in 3 new markets. The US market was a big launch for us early this year. Now that's important because the US is the largest travel market in the world. So we've launched with one of our target insurers in that market. We've also launched in Italy and in the UK market. In Italy, we've launched with Europe Assistance, and we're looking to work with Europe Assistance, who are 40% of the travel insurance market in Italy, to kind of scale into other parts of their business. Again, in line with our core strategies and organisation. What we're seeing in the first half, though, we've seen a significant increase in the pipeline for Blink as we developed our pipeline across 2022 and 2023. We're now starting to see that pipeline come through the other end into contracts and revenue. Never, as Simon again said, not as fast as we would hope they were coming through, but the scale and size of the organisations we're working with, it takes time to work with multiple parts of those organisations and get to a commercial contract and get live. But once you're in, you've got a significant opportunity to scale and grow with those businesses. As Simon said, we launched two clients already in September, which we will be talking about in PR soon, and we've got another one due to go live in September. So we're starting to see a faster throughput of new clients coming through now based on the pipeline that we've developed over the last year and a half. We've got some good progress in the US with a couple more insurers, and we are now really seeing a strong opportunity in the banking sector, driven from direct engagement by ourselves, but predominantly via insurance partnerships that we've developed with existing partners and new clients to operate travel insurance into a sector which is looking to differentiate heavily in travel. When you look also to the side away from new business, we've seen strong operational cover within the organisation. We've been through a process in 2022 and 23 about ensuring that Blink is able to genuinely scale at the pace we want it to scale with the types of clients we're looking to bring into the business that have now already. We've seen some good improvements in the engagement and adoption of our technology in 2023. I've got some stats on this slide of a 250% increase in claims that are paid using our technology, another 150% increase in policies sold, which include our technology in the first half versus a year ago. Now, these are large numbers now running through our technology platform within Blink, and we're very confident from the work we've been doing in the last year and a half that we're in a position where we can genuinely scale this business with the large growth that we're anticipating. I won't go into awards, but we've won lots of awards in the first half of this year, as we did in 2022. But the awards help us build credibility in market, educate the market, the solutions we operate, and it's great to be recognised for the disruption we're bringing to the travel insurance market globally. I've talked about some of this already, but it's a primary importance that as we scale Blink with the types of clients that we're working with, so the types of clients we already have on book, such as assurance, very large multinational insurance business operating in 40 markets, Europe Assistance, Blue Cross, Manulife, some of the kind of brands that we already operate with. We need to ensure that the technology solution that we operate scales, is robust, can deliver what we say it's going to do. And we've made a significant strides on that process in the last year and a half. We're now very confident about for this year, the solidity of the platform, the scalability of it. And one of the big achievements in the first half of this year was deploying a brand new user experience. There had been no investment in user experience in Blink since the business was set up in 2017, very little. And we recognise that was a key differentiated requirement for our organisation to be able to deliver brand experiences in line with our clients' needs. So we've developed, deployed and launched brand new user experience. That will give us over time the ability to significantly broaden the services we can offer to our existing clients and new clients, including the ability to leverage the data sets I mentioned earlier to be able to bring other services to consumers, as that we know when they're traveling, where they're traveling to and who they're traveling with. So we can broaden the service opportunity that we provide and give to our insurance partners and their end clients. We've bolstered our team as an organisation. So we've grown the team within Blink to ensure that we've got the right skills to be able to scale this business effectively. And we've moved into a new operating office in Cork, which is the HQ for Blink, which again gives this business a really great baseline in the EU to be able to leverage distribution opportunities across that market. I think I've covered most of the highlights, but within the slide deck, there's a highlight slide. I think I would just say that we work with some very excellent large insurers. Our pipeline is growing quickly with large multinational insurers, and we would expect in 2024 a number of those clients to drop into contract deals and new revenue generation as we go forward.
Thanks for that, Sid. I'm David Bowling, the Group CFO, and I'm just going to quickly run you through some of the key financial highlights from the first half. Now, Simon's touched on some of these earlier in the presentation, but what I'll try and do is just provide a little bit more colour about the key drivers, especially around the revenue movements and the EBITDA performance. So we reported revenue of 93.5 million in the first half, which was a 21% increase on prior year, or 25% increase on a constant currency basis, because as we talked about earlier, our main trading currencies have just slightly worked against us during the first half. Most of that revenue growth has been generated from India, which has increased by just over 19 million in the first half compared to last year. Now, that is really across a number of product sets, majorly Live Care, which we talked about, which is the health and wellness product that we sell in India, which has increased by over 12 million compared to the prior year. We've also seen a resurgence in our card business during the first half. So the card business was particularly hit last year following some changes by the RBI in late 2021. But the banks have now adopted the changes that are required there, and we've seen a real resurgence in the card business during the first half of this year, and we expect that to continue into the second half and beyond. And we've also seen an increase in our mobile sales, which have increased by 3 million in the first half. If we move to Turkey, I mean, it's a much smaller number than India, but it has increased 600,000 on a local currency basis, which is through a combination of growth in the new business partner base, but also the fact that we are seeing a growing renewal book out there, which gives good returns. We have seen greater sales with Turkey Insurance. That's really what's driven the increase in Turkey in the first half. So Turkey Insurance is a super insurer that was created during 2022, and we now partner into 3 other banks that through Turkey Insurance. We've seen good growth there. As ever, the challenge in Turkey is keeping up with inflation. But we're managing to do that at the moment through both volume growth and also the good relationships we have with our partners, which has enabled us to also recognise some price increases, which again will aid us through the second half of the year. As Simon touched on, in Turkey, on a local basis, revenue's grown 70% compared to the prior year. But because of the depreciation in the lira during the first half, that's actually flat on a reported basis. So all the good work that's been done out there on a reported perspective is eroded. Blink, I'll just touch on that, has increased by 0.2 million as well, which doesn't look a lot. It's not growing as fast as we might have hoped for, but that does represent an 82% increase on the prior year in revenue. But as Sid talked about, we do have a strong pipeline in Blink. It gives us a lot of confidence. And in reality, that pipeline now is 6 months further advanced, and therefore the economic contracts we expect to be that little bit nearer to landing. We will focus very much on this business. I mean, we've got reported revenue here, but we'll focus very much on annual recurring revenue as a technology business. And the annual recurring revenue for Blink has increased to 0.8 million at June through new partner launches. And today, that's probably nearer to 1 million. So, we do expect that to grow further, but, we're seeing some good progress in our annual recurring revenue. The legacy business is declining as we expected, and that's reduced by 1.4 million in the year. And as I just touched on, the last block in the chart here, we have had our main trading currencies work against us. So we've had a negative foreign exchange impact of 2.9 million on that reported revenue number, which is through a combination of India and the rupee, which has impacted by 2.4 million, and Turkey by 0.6 million. From an EBITDA perspective, at a group level, we're flat on prior year at 2.9 million, but there's a number of moving parts in there, as this walk really shows here. In India, it's probably worth touching on first, where we've got a flat performance. What we've really seen here is the benefit of strong revenue growth being lost through margin erosion, which has largely come through changes in mix in the product sales. So we talked about the fact that Livecare sales have increased, but Livecare actually represents our lowest margin products in India. We've also seen a shift in our mobile sales, in the mix of our mobile sales, towards higher value handsets. So whilst this actually carries a higher revenue, it is again a lower margin product for us within mobile. And also I talked about the resurgence in the card business, which is a very positive note for us. However, what it does do in the first year is that you have high acquisition costs in terms of acquiring that business. And so actually card is loss making in year one, but then what you really do is you benefit on the renewal streams from much, much higher margin, and you're building a book with some recurring value. Blink's losses have increased by 0.6 million compared to prior year, which really just reflects the investment in the headcount that we've put in to scale this business, so it's ready to really motor when the new business is gained. Encouragingly, central costs continue to reduce, so they're 0.2 million lower than last year, which is a reflection of headcount reductions and cost control and scrutiny, which is pleasing when, as we all recognise, we are currently operating in an inflationary environment, and this will continue into 2024 and beyond. Our legacy business, although the revenue is down as we expected, actually EBITDA has increased in the first half, which is really a quirk of exiting businesses. We're particularly seeing this in Spain, which has increased on the prior year. That's probably down to two factors. First is the terms that we agreed with our main underwriter in Spain to transfer the book to them. So this is on a beneficial basis and has actually provided us some additional profit whilst that book remains with us, but that will transfer over in its entirety in Q4 this year. And also, as a result of winding down the business, we've seen some early headcount reduction as well, particularly around the sales team, which is an expensive function, which we were able to remove at the end of last year. And also, we've seen some improvements in our MGA, UK MGA performance, which again is just the fact that we made the decision to exit the MGA in the first half of last year. We went through the process of reducing the headcount last year, so the cost was done in the first half, but we have the benefit of that not being there in this half. And from an FX perspective, we've had a negative 0.2 million impact on the reported EBITDA. I think probably a lot of the margin chart has been explained through my explanation of EBITDA performance and revenue. What we have seen is India's margin reduce from last year to this, from 5.1% to 3.9%, which is a reflection of the mix that I talked about on EBITDA with Livecare sales, mobile, and the increase in the card book. Turkey has seen a good increase in its EBITDA margin, up 4.8 percentage points. And what this really reflects is an increasing sales mix trend towards outsourced sales. So outsourced sales actually represent a lower revenue per policy sale for us, but actually represent a higher margin. So we've seen the benefit of that coming through in the margin there. And legacy is improved by 7.1%, which is just the quirk of the improvements in Spain and the UK MGA that I was referring to. But what that has done, because as our mix continues to move toward, our group mix continues to move towards India, what we're seeing is some continued pressure on the group's EBITDA margin, which has reduced from 3.8% to 3.1% in this half. As we move through the change program, cash is going to be crucially important. It always is, but will become ever more so. And what we have seen is that cash has reduced by 5 million since the end of the year, since December, to 16 million. Now that reduction has really come through some working capital factors in India. A legislative change has meant that we've had a change in timing, an adverse change in timing of some of our payments to partners. Although we do expect that impact to reduce over the second half into 2024 as the mix in sales changes and actually reduces that impact. As you can see there, we've had a CapEx spend of 1.8 million. So that is primarily on our Indian IT platform that we've been talking about. So phase 1 is now operational, and phase 2 is underway, and we expect the expenditure on that to be largely complete by the end of the year. As we keep saying, the change management program will consume cash over the next 18 to 24 months through a combination of redundancy payments. We have significant liabilities in Spain, and we'll also have liabilities in the UK. We will also have the costs of continuing to service our policies in the UK, even once the revenue is turned off, and the revenue will be turned off and income will be turned off at the end of this year, but we will continue to service the policies for up to 3 years. And certainly over the next 12 months or so, we will have continued investment in Blink to ensure that it realises its potential, and the IT platform too. But what we do have, in the first half, is that we renewed our loan facility, our 5 million loan facility for a further 3 years. So what that will do is, as we go through this change, it will provide us some working capital flexibility, which will enable us to, we see, being able to manage this change program with the existing resources that we have. Okay, that is the presentation from me. I'll pass back to Simon, who will just sum up.
David. So, just in the formal part of the presentation, business pretty much performing as we expected. We were expecting some of the margin movement in India and at a group level. I guess the surprise was really the FX impact. As David showed, 200,000 off the EBITDA as well after that. Change management program is progressing well. It's just going to take time to fully execute it. But we have some proof points now around delivering the phase 1 IT platform in India. That's now delivered. On track to deliver the second phase and the final phase by the end of this year, early next year in January. And we continue to build scalability for Blink, and that should be done by the first quarter of 2024. And Blink's making good progress. We are, as David said, we've got annualized contract, and that's the minimum values of these contracts, not volume related. Minimum values in these contracts, 800,000 to 1 million. Expect it to be up to 1.2, 1.4 million at the end of the year. And really, for us, each test will be that each reporting period, that annualized contract value is increased. So overall, it's a satisfactory state of affairs. There's just a lot of work to be done between now and hopefully getting this business to where it needs to be as we come into 2026. Well, thank you.
That's fantastic, Simon. Thank you very much indeed. David said as well, thank you very much for your presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question, press send. But just while the team take a few moments to review those questions submitted today, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we received a number of questions, both pre-submitted and throughout today's presentation, and thanks to all the investors for submitting those. David, perhaps if I could turn to you just to ask you to read out those questions where appropriate to do so, and either give a response or direct it to a member of the team. I'll pick up from you at the end.
Okay, thanks, Paul. As Paul says, we've got a few questions here. Just run through them in turn. First one, although Globeva is categorised within core, as previously stated, it operates separately from the group, albeit with some CPP India business relationship. Surely there is shareholder value to be derived from cashing in on this investment. What is the medium long-term plan for Globeva, and how do management anticipate maximising this value for shareholders? Simon, do you want to start?
Sure. Yeah. So Globeva is non-core for us as a business. We will look to exit from that relationship at some stage. By the end of, I think the end of 2025, and their purchase agreement, they've got a call option to bring us down to around 41-42%. The issue with it's not a question of if, it's a question of when. You know, at the moment, it has no international clients. They're all local tech businesses in India. That attracts less of a premium on a sale, as if it had hired more blue chip, say, multinational firms, and they're largely tech focused. Which are going through a bit of a crunch at the moment. So it's business still profitable, but you won't get a premium for it. So, and as I said earlier in my presentation, you know, if we look to go down that route now, it'll just be distracting, shall we say, for management, because David and I would have to get heavily involved in that exit, you know. So it's on the list of our strategic objectives to exit from that relationship at a time really where we think we'll get a little bit more value out from them. But you know, this is not a business going to deliver £50 million sale per proceeds to us, you know, or in total, of which we would give a share. You know, this is not that sort of transaction. Okay, thanks, Simon. Second question, margin erosion in CPP India's operation has been a long-standing trend. Rather than strengthening its position as the revenues grow, the business seems to be more beholden to Bajaj. What is the plan to turn this around? The delivery of the first phase of the IT platform is encouraging, but unless it allows the business to pivot into developing a direct-to-consumer proposition or enable to hold more leverage over Bajaj, then it appears to be nothing more than a costly exercise. Sometimes you just have to step off the treadmill. What is management's view on their margins in CPP India can get to over the medium to long term? The honest answer is not a lot you can do about the gross profit margin. You know, even if we started a new business from the 1st of January that was going to do 10 million of annual revenues a year in year one at margins of say 20%, you know, even after 5 years, it's not moved the dial because of the size that Bajaj has now become. It's just even compound growth at 10%, you know, on a £10 million new revenue stream, you're not going to materially change the margin percentage at all in this one. So our focus is a couple of focus. One is to try and improve the EBITDA margin by reducing their cost base, and that's one of the reasons why they've got the IT platform. Originally, they were being charged £2.5 million a year for their share of MPP and Protect legacy system costs in IT. Their annual India costs will come down by about £1 million, so their EBITDA margin improve. And then it's to build other products, with slightly higher margin products, and selling them into places like Tata and others. But those ones, it'll be about EBITDA margin, but it'll be fractional just because of the size of that. But intrinsically, India creates a lot of interest in the business, because there was an EY report that came out a few months ago, where, based on current expectations, India will be the 3rd or 4th largest economy in the next 20 to 30 years, you know, sitting behind China, the United States, and then there will be India. And that probably would, if we were ever subject to an acquisition or a target acquisition, that may well be one of the attractive features to us. As I said, as we get to the end of 2026 or in 2026, we still have a business that seems a little inconsistent. We've got a little bit of the old business in India and Turkey, and then we've got the parametric business. And you might want to sell it or look at that, so they do something M&A. But in terms of near-term ability to improve the gross profit margin, there isn't a lot of scope to do that.
Thanks, Simon. I don't think I've got anything to add on that. Blink's revenue growth period on period is encouraging, albeit this is from a very low starting point. Cost growth still appears to be materially outrunning revenue growth. when do management expect all this to turn around or turn the corner?
I'll answer.
And how can shareholders be assured that this money is being well spent, and what do management expect the future value returns to be?
I mean, it's always hard to give assurances. Life's not as perfect as that, but so simple questions. We go through some maths. Once we get to about 2.5 million of revenue on Blink, we basically on this current cost base, we break even, and so that it'll be self-funding. The decision at that stage then is how do we further accelerate the investment in Blink, put more infrastructure in, put more software engineers in, all which gets spent through the P&L, and we'll make the decision as and when we come to it. But if it gets half right, as I said earlier, if we get to £6 million of EBITDA, 6 million pounds of revenue, say on an annualized basis at the end of 2026, with some inflation on the cost base, you're going to be looking at a business which is generating 50% EBITDA margins, highly cash generative, annualized contracts, and it looks like an annuity business. And that, I know we have a bit of a revision on pricing at the moment, but even if that 6 million revenue was valued at 10 million, that's 60 million pounds of value. And if I'm only half right in the valuations, that's 30 million value. That's double the current market cap of CPP. It's the only product that we can launch globally. And it's the future of assistance products which have an insurance element into them. This is the future. It's this and AI. It's, your traditional insurance business is rapidly changing, and it's changing in our direction. I mean, I can't give you any assurances. I'll give you my endeavours to get there. We have a good management team. We know what we're doing. We have clear plans. It may take a little bit longer than we're hoping. It may actually, one of these whales may turn around and deliver super returns faster than we're expecting. But I would have thought by the end of on an annual, at some point during 2026, we will be close to that 5 to 6 million of annualized revenues, and that for me will be a real benchmark. We expect on our existing portfolio there's a market for 20 million pounds over several years, but we don't have the infrastructure to kind of leverage all of that at this period. So I would have thought, as we progress each quarter, we want to see a nice tick up on those average transaction annualized contract values. And I'd rather, and I've got the team focused on delivering quality. It's easy to chase revenue, but revenue doesn't repeat itself and has no real intrinsic value. What we're trying to build is a quality business, and I can give you a really bad business and give you a great return. I can do it quickly, but it won't last. So that's what we're trying to create, a big business here that's got legs and has got quality engineered through it.
Thanks, Sam. We then had another question, actually, just on a similar vein, just about the new incentive plans that we're putting in shortly, how they're attached to share price targets, which is good to see. However, it's difficult to see that in the absence of a coherent inorganic growth plan, how we can achieve some of those targets. There has to be aspiration, but how realistic is this? I think that really ties into the Blink.
Yeah, it does. I'll just go through it on a slightly different stance on that one. We don't have the firepower to go through a buy and build strategy, so we have to have an organic strategy. We need our cash resources to fund the group and the working capital as we exit the legacy business. And there's no investor appetite for me to write to go for a rights issue to try and raise X million. I mean, what could I raise at the moment? 3 or 4 million. There's not a lot you can buy at the moment, but that doesn't really get to the heart of the question here. When I was in global data once before, and people were asking, and those businesses were seeing rapid share price growth, asking what our aspirations were as management team, I always pointed them to the LTIP, and I said to them, look, this is what we've been incentivized on. This is the period that it is, and can I see us getting to £6? Yes, I can. Once we get to 2026. And you've got numbers out there that Blink's doing 6 million, Indians as currently doing what's currently doing, Turkey's doing what's currently doing, and the centre has come down to 4 or 5 million overhead. You can easily see that business being worth around the 60 million mark. You could attract a 30 million valuation on Blink, I'll say, even on 6 million of revenues, and that's at a quite low multiple. India, on an EV or an EBITDA multiple, will get you another 30 plus. You're sitting there at 60 million. Well, that's not how I manage the business, but why we set the £6 target, because that's what we're trying to get to. We had our valuation assumptions on the sum parts tested and checked by third parties and our advisors. They just look ambitious because our share price is so low. But in 2017, the share price is what, £13 a share. Now we won't get back to that, and it's been on a downward trajectory since then. But I would be disappointed if we couldn't get to that £6 mark. We've got a 5-year period to get there.
Last 2 or 3. How much investment needs to go into the main revenue-generating operations, and can you launch the offerings into other countries?
Yeah, I mean, the Blink, for example, is we expense the cost we go. So all the software and IP, it's all some global data. You create it and you just largely run it through your P&L. We have enough resources at the moment to launch our travel product into multiple geographies alongside our partners. As I said, it's built once and delivered electronically globally, so we don't need techies in each of these jurisdictions. On the dark web monitoring side, we're partnering up with large firms, say TransUnion. They have asked us they are aware that we want to incur a huge amount of additional costs pre-revenue, so they will help fund our investment and overhead and through margin to take on additional headcount, so we can do continuous improvement in the cyber product. But as we get more visibility on Blink's revenues, we'll take decisions in us about what's the next wave of products and what's the investment to go with that. If we start to get significant traction in the United States, you might think actually we want a couple of account directors to sit there with the large underwriters and banks and travel companies just to make, because they're 5 hours, 6 hours ahead of us. But it's not. So at the moment, we have enough resources in the budget and spend for next year to deliver the numbers we're aiming for. But if we start to get towards those numbers that look like we're overachieving them, then we'll take a view as to whether we want to invest further. But I think what we want to do before we get too excited and try and build out this wonderful insurtech business is come back to our shareholders and say, look, we told you this, that's what we've delivered, and then keep doing that for 6 reporting cycles until shareholders who have suffered for a long time and new people that are interested in the business are confident with doing what we're paid to do.
Okay. At this stage of the plan, what does near-term success look like?
I think we don't know. We haven't got 26 numbers published in yet through our broker. But I would have thought 6 million. I mean, you can pick up I would have thought 5 to 6 million revenue number on an annualized basis in 26 for Blink, which is another 5 million on their reporting now. That would be very good performance. And then just say India and Turkey, pretty much similar sort of numbers they are, plus some inflation, but the central costs down by a couple of £1 million because of the change management program, and all the legacy businesses closed. So that's what I kind of think of in my head where we get to. I mean, ironically, when you go to Brief Librum, their spreadsheets only go to X number of months or years ahead, and it stops at 25. But actually, our upswing, because we've exited the change management program, comes out in 26. So I can't give you the numbers because they're not out in the market. But if you're asking a kind of loose conversation, that's how it would look to me. 5 to 6 million in revenue in Blink, lowers the group central cost, and you could just desktop what we put in there for India and Turkey, and you kind of get to where we think 2026 will be.
And final one, will the exceptional cash item in India unwind itself with the Bajaj contract length? I think I'll pick this one up, Simon. So the impact of it will reduce. I mean, the factor that is leading to this change in timing will remain. It's a legislative change in India, particularly around incentive payments. So that has accelerated the timing of payment from our perspective. What we expect to see over the next 6, 9, 12 months is that actually the sales mix on which those incentive payments will change, and that will actually mean that there is a lower element of sales that's attached to these where these incentives actually land. So it's not directly linked to the Bajaj contract length, The factor won't go away, but we do expect the impact on us to reduce.
That's fantastic. Look, thank you very much indeed. You've covered off all the questions we've had. And of course, any further questions that come through, the team will have the ability to review those and we'll publish responses where appropriate to do so. Simon, perhaps just before redirecting investors to provide you their feedback, which I know is particularly important to you and the team, I could just ask you just for a few final closing comments, please.
Yeah, I think first half results in this year will be pretty much what we expect to do as we set out. So, we do have some currency headwinds that we're expecting to last, obviously, to the end of the year, into next year. But we, because of tight cost control, we expect to absorb all that impact next year. Change management progressing well. I mean, and Blink's, not working in terms of converting contracts as fast as like, but all the proof points are positive. There's no contradictory messages. No one's run off and screamed, "Don't darken my store in the doorstep anymore" with this product. So it's been well received. So, I'm probably the most impatient man in the group, but we are pragmatists before we are optimists. And so, I mean, if I was looking at it, it's a B. We give ourselves a grading system A to C or D. It's a B result. I'll never ever grade ourselves A because that breeds complacency. But we set out and delivered everything we set to in the first half. We're 3 months away from the end of the year. I think we'll deliver everything again. We said, there might be a bit of movement in terms of when we sign contracts on Blink and delivering phase. That's done. 2024 is going to be a tough year. Lots of the change management program being implemented. Lots of staff leaving. That always is a bit dynamic. And again, more contracts and work to do with Blink. But it's just small steps in the right direction. And I guess the criticism will be more about speed rather than direction.
That's fantastic. Simon, David, Sid, thanks indeed for updating investors today. Can I please ask investors not to close the session, as we automatically redirect you to provide your feedback, and all the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of CPP Group PLC, we'd like to thank you for attending today's presentation and good afternoon to you all.